Yeah, despite a down day on Friday, Louisa, and as I mentioned, the major indices did hit bear market territory on Tuesday. The Dow, Nasdaq, and S&P 500 still managed to close positive for the week. The Nasdaq actually was pretty strong with 2.6% to the upside. Let's talk about this in this week's market with Tom Lydon, editor of ETF Trends.com, and still with us, guest host David Miller, head of alternatives and partner at Cheviot Asset Management. Tom, I'll begin with you generally. Just give me your broad sense of the markets right now with all the volatility entering earnings season.
Absolutely. Well, it's nice to have a positive earnings outlook as we've continued to beat expectations the past 3 quarters, but it hasn't been enough to boost investor confidence. The confidence level is down to the levels that we saw in March of 2009, which really isn't that great. And if you look at fund flows, mutual fund flows here in the U.S., tens of billions of dollars continue to flow out of equity mutual funds, and many are moving into alternatives like gold, long currency, and short ETFs. So that's something that we're watching very closely as the risk-off bet continues for the average investor here in the U.S.
Well, I guess the question is, can earnings, regardless of whatever the headline risk is across the world, Tom, are earnings enough to maybe change that paradigm?
Well, unfortunately, even though we've had beat expectations the past 3 quarters, it hasn't been enough. And it's nice to see an announcement out of the Eurozone that there may be a plan, but the devil will be in the details. And I think investors here in the U.S. are going to sit back before they move and have confidence to go back into the market. They're going to want to see what those details look like.
David, how confident are you on the upcoming earnings season?
Well, I think the earnings numbers are going to be good. It's coming off the back of a strong period of recovery. And the doubt really in investors' minds will be how positive will the statement be or negative, and what sort of expectations are in the market for next year. And it looks to us as if the expectations for next year at the moment still look on the high side, which means the numbers come through, we're happy with that. But it's going to be what can we now look forward to? And I think there's a bit of concern that investors are still doing the optimism for next year.
Overdoing the optimism, Tom, and maybe also companies, especially stateside, sitting on cash, not because, hey, it's great we have a lot of cash, but because they haven't been able to plant it anywhere because of the terrible environment.
Well, you're absolutely right, Louisa. I mean, there's tons of cash here, but the average company is happy to just keep their powder dry and sit on it, waiting for some positive news that might be sustainable. And in the meantime, the average investor is frustrated with equity markets, is looking for alternatives. They're looking for yield. And as we're hitting 50, 60-year declines in yield, it's somewhat frustrating, but in the meantime, safety is the key word.
You know, Tom, you talk about chasing yield, and we're going to get into ETFs a little bit more in about 10 minutes or so. But is the retail investor, the money that's bailing out and rotating into alternatives into cash, that's the pros? I mean, did the retail, from your perspective, ever come back at all since '09?
Not really. If you look at the fund flows over time, in the last 2 years, Brian, we've seen $1 trillion go into bond-related mutual funds and ETFs, which, again, from a safety move, that's understandable. I think going forward, hey, eventually we're going to get some traction. The economy will pick up. But when that happens, that's probably the next wave and big concern that we'll see. The bond bubble will burst, and for the average investor, I don't think they understand what interest rate risk is all about. So ETFs provide great alternatives in that regard because there are short treasury plays out there to be able to protect from an income standpoint.
Yeah, and I want to talk about that in a few minutes, especially as the popularity of the commodities ETFs have blown up. Tom Lydon, we appreciate it. You'll stick with us a little bit more. ETFtrends.com. Of course, David Miller, head of alternatives, partner at Cheviot Asset Management, staying with us for the rest of the hour as well. Welcome back to Worldwide Exchange. I'm Brian Shackman. Let's take a quick look at the futures here. They've slipped just a tiny bit against fair value, but we're still about 80-plus points to the good in the Dow, and we're positive in the NASDAQ and the S&P 500. So right now we've been in a very tight range, but we are strongly positive, although it is slipping just a little bit. Let's bring back in Tom Lydon, editor of ETF Trends.com, and of course our guest host David Miller. Tom, since your ETF is the focus here, and we've talked about outflows from equity markets of late, where are you seeing money come in terms of the ETF space?
Well, first, in a flight to safety, it's treasuries. And, you know, the iShares 20-year Treasury ETF is really been booming as far as assets flowing in. The other alternative, we've seen 15% of ETF flows recently going into short ETFs. So for the average investor, as opposed to shorting individual stocks, you can actually short a complete index and trade it just like you trade an individual stock. So those that have low cost basis positions, it's a great way to hedge your portfolio.
And in terms of, what about the commodity space? I've just read so much, and we had the huge run-up in prices like wheat and cotton and a whole bunch of other things, and we've had some sharp pullbacks. Is there a lot of money coming out of the commodity ETFs now?
No, actually, it's been holding steady. The idea here is, in the last couple of weeks, when we saw kind of a flight to quality, and there were a lot of margin calls that were coming in, we did see some selling. But just recently, in the last week, things have been booming again. The great idea with commodities for the average investor, you didn't have the opportunity to invest in commodities this easily just 5 years ago. And it's not just gold and silver. For example, last week, the best performing ETFs out of all ETFs were copper-related ETFs. So there's agriculture, there's energy, there's solar. So for the average investor that's looking for more diversification in the commodities area, you've got tons of choices these days.
David, what's your view of that the whole space? Have you embraced ETFs wholeheartedly, or do you stick with your individual equities and so forth?
Sticking more with the individual equities and active management of asset allocation. It's really interesting to see where the flows are going into the ETF market. I think that's fascinating, and it almost makes me feel a bit more optimistic about equities, listening to what's just been said. You know, the idea that the flows are into treasuries and into short ETFs means that any hint of a bit of good news, it's going to put this market significantly higher.
Yeah. David, I just want to mention that a German finance minister's spokesman is saying via Reuters that depending on what the EBA says about the German banks, that will decide whether to reactivate SOFIN, and of course SOFIN is the German bank rescue fund, so just make note of that. Safe haven flows in the currency space, where do you see safe haven flows? Well,
I think the safe haven issue is a real problem for investors because they moved into currencies like the Swiss franc or gold, if you want to call that a currency, and then they found they lost 10% really very quickly. The latest fad has been US dollar and treasuries, as we just heard, and it could go exactly the same way. So I think the only way out of getting hit in these safe havens is not to believe that there's any one single solution.
I want to thank Tom Lydon, editor of ETFtrends.com, and of course David Miller, head of alternatives and partner at Cheviot Asset Management. We really appreciate the insight.